Hey, this is Yusuf, a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss 3 high-yielding REITs offering dividend yields of up to 12%. Typically, such high yields are a major red flag in the REIT sector. It's the market's way of signaling that the REIT might be over-leveraged, poorly managed, or that it owns troubled assets that are experiencing declining cash flows. But I think that these 3 REITs are a bit of an exception. I actually think that they are relatively high-quality REITs with good assets, decent balance sheets, shareholder-friendly management teams, and I think their dividends are sustainable and set to grow even further in the long run. But they're offering such high dividend yields because they are today heavily discounted. Before I get started, can you please do me a huge favor and click the like button, subscribe to the channel? Helps me a lot to keep on growing. Thanks so much in advance. Okay, so the first opportunity that I want to discuss are the Series A preferred shares of innovative industrial properties, ticker symbol IIPR/A. Depending on the broker, the ticker might be a bit different. With Interactive Brokers, it's IIPR.PR.A, I believe. Again, it depends on the broker. Each broker has slightly different ticker structure for preferred shares, so you'll have to look it up online. But so this is the biggest REIT focusing on cannabis cultivation facilities. Typically, these are triple net lease deals where the tenant will be stuck in one lease for a very long term of 15 to 20 years. It will be responsible for all property expenses, including even the maintenance. And the lease will also include annual escalators of 2 to 3% that are quite typical in the cannabis sector. And so the cash flow ends up being super consistent and predictable for the landlord. It results in bond-like cash flow, really. However, the cannabis sector is a bit riskier than other property sectors in that the tenants are typically quite weak, and so it's inevitable in this space to occasionally face some lease defaults. And this particular REIT experienced that not too long ago, as its biggest tenant, representing 16% of its revenue, defaulted on its lease. This caused its common equity to crash. I'm personally not interested in the common equity. I think it's a bit too risky. But the interesting thing is that preferred equity dropped quite a bit as well. And now it's offering a 9% dividend yield. It's trading at an about $1 discount to its par value. So there's a little bit of upside also to par. Historically, it has commonly traded at a premium to par. So I think that there's about 10% upside in addition to the 9% dividend yield. And I think that the preferred equity is perfectly safe here. The interesting thing about this particular REIT is that it has very little leverage. Its loan to value is only about 20%. So if you're investing in the preferred equity, you have a very significant common equity buffer of about 80%. Typically, when you're investing in the preferred equity, the common equity buffer is much smaller than that because REITs will operate with LTVs closer to the 40-50% range, especially if you're targeting such high yield levels. So here you're getting an unusually high yield with a very low LTV, and that's quite compelling, I think, coming from the perspective of a preferred equity holder. And historically, this REIT has always been able to resolve its tenant issues with limited damage to the REIT in the end. It has already resolved the recent lease default. It only resulted in a very limited rent cut. It repossessed a few of the properties and it's now looking for tenants. But again, the impact on its FFO, on its bottom line, is quite limited. I think the outlook for the common equity is uncertain and it deserves to trade at a relatively low valuation, given that this is a riskier property sector. But again, I think that the preferred equity here is perfectly safe, and yet it's offering a 9% dividend yield, and that's why I like it so much. Now, the second company I'm going to cover is called Easterly Government Properties, ticker symbol DEA. This is a REIT that I've covered quite a few times on this channel because I've warned my audience that the company was likely to cut its dividend. I did it also on Seeking Alpha in quite a few articles. And well, the dividend cut has now finally arrived. They cut their dividend by, let me check, yes, 32%. It's quite significant, but the interesting thing here is that even post-cut, its dividend yield is still 9%, and that's with a conservative 75% payout ratio, and that makes it, in my opinion, far more attractive than prior to the cut, when we had this potential overhang of a cut coming pretty soon. Now we've gone through that. The share price has crashed. The valuation is even lower than it already was, and now we have a conservative, sustainable dividend that's still yielding 9% with a relatively low payout ratio. And I think that this particular REIT is quite attractive in today's environment because it's recession resistant. It's not impacted by the tariffs. Remember, these are government leased properties, so these leases are backed by the full faith and credit of the US government. These are things like FBI regional offices, VA outpatient properties, some courthouses. Most of these functions cannot be done remotely either, so they're not heavily impacted by the growing trend of remote work. Some investors are today scared of the Dodge effort to cut down on federal spending and how that could impact DEA. But just recently I got the chance to talk to the CEO of Easterly Government Properties, and he's telling me that they don't expect any major impact. On the contrary, it may even end up benefiting them, because this is reaffirming that leasing is more efficient than owning real estate for the government, and so it could lead to more acquisition and development opportunities for Easterly Government Properties now in the coming years. This is one more reason why they decided to cut their dividend, as it will allow them to retain cash flow to take advantage of these new opportunities. Let me know in the comment section below what you think of the Dodge efforts. Do you think it will have a major impact on this REIT? I mean, again, keep in mind that federal spending is expected to actually go up in 2025 compared to 2024, even despite all these headlines of major cuts being done by Dodge. So in my opinion, this was much more show than anything else. They've made some cuts, but they were nowhere near what they were planning. At first they talked about 2 trillion worth of cuts, then they cut it down to 1 trillion. Now it's expected to be about 100 billion in the end. Meanwhile, some other federal spending is actually rising. Elon Musk has also been reported now to reduce his involvement with the effort and refocus on his businesses like Tesla and Starlink and so on. So again, I think that this was more show than anything else, and even if you disagree with me, the leases of DEA are not cancelable. They have 10 years left on them on average. These properties serve a mission critical purpose to the government. President Trump has recently mandated government employees also to get back to the office, which increases the need and the value of these properties to these government agencies. And again, once more, the CEO told us that they really aren't concerned about this. By the way, if you want to read a full interview with the CEO of Easterly Government Properties, I've temporarily made it completely free on our REIT newsletter, High Yield Landlord, so you can read it without signing up for the paid version of our newsletter. The only thing that we'll ask you is that you leave the email and sign up for the free version. I post regular free content on some of my favorite REIT opportunities, and you don't want to miss out on it. You'll be the first link in the description of this video. To recap, the REIT has 10 years left on its leases. It's offering a 9% dividend yield with a conservative payout ratio. They expect to grow the FFO per share by 2 to 3% annually going forward. And so I think that's very attractive, especially in today's uncertain world, especially coming from such a high credit tenant. And so that's one reason why I'm considering to add it to our portfolio at High Yield Landlord at the moment. Okay, now we go to the third REIT that I want to discuss in today's video. That's New Lake Capital Partners, ticker symbol NLCP. It's a REIT that I've covered quite a few times on this channel, but I have some new exclusive information for you that's quite interesting, which I got from another CEO interview that I did with this specific REIT. It's today offering a 12% dividend yield, and I got to ask the CEO what they think of the dividend, how sustainable it is, because, you know, as I said early in the introduction of this video, typically when REITs offering such high dividend yield, it's a red flag that perhaps the dividend is risky. And so I asked him directly, how confident are they in maintaining their current dividend yield? And here's their answer. Our Q4 FFO payout ratio was 83%, comfortably within our target range of 80 to 90%. This provides a 17% buffer to absorb potential credit issues. Our 3 largest tenants, Curaleaf, Cresto, and TrueLive, are widely considered among the strongest credits in the cannabis industry, and no other tenant represents more than 8.5% of our annualized base rent. We also see the opportunity to grow FFO per share through portfolio-wide rent escalators of 2.6%, funding our $11 million committed tenant improvements, and new investment opportunities that are funded through our $90 million credit facility. And so they are very comfortable with their dividend. They think that it's not only sustainable, but set to grow further in the coming quarters. As he said, their payout ratio is already in the low end of their target range of 80 to 90%, which in my opinion was a clear hint that they expect to hike it further, especially as new rent escalators kick in, they acquire new properties at a significant spread over their cost of capital. And keep in mind that despite the high yield, this is one of a few REITs that has managed to hike its dividend in nearly every quarter since going public. I'll put a chart on the screen. You'll see there that has hiked it very consistently. It hasn't cut it once, even despite the challenges that the cannabis sector has faced in recent years. And so the high dividend yield is simply the result of its very low valuation, trading at just 8 times FFO. Here you may ask yourself, why is the valuation so low if the company is doing so well and growing consistently? and it's simply because it's focusing on the cannabis sector. Just like its bigger peer Innovative Industrial Properties, which we discussed earlier in this video, it's facing occasional tenant issues, and the market doesn't like this bumpiness, and so it's penalizing the REIT with a low valuation. I think it's fair. However, the difference between NewLake Capital Partners and Innovative Industrial Properties is that NewLake has been much more disciplined, in my opinion, with its acquisition. It didn't go through a period of explosive growth like Innovative Industrial Properties did in its early years, when its cost of capital was very low and was able to acquire just about anything at very large spread of its cost of capital. NewLake never had this opportunity to have such a low cost of capital, and so it has had to be much more selective and disciplined about its acquisitions, and it has built a portfolio exclusively of properties that are located in limited license jurisdictions. And I think that this is a major risk mitigator in the cannabis sector, because the demand is expected to keep growing rapidly over the long run, but the supply of these properties are strictly limited by these licenses, and so you have limited supply but growing demand, and so this should, in my opinion, help them preserve value and grow value over the long run. And so even if they lose a tenant here and there through a bankruptcy, they should be able to refill these properties since there is a clear need for them. The company also gets large security deposits from its tenants, it has significant liquidity, and it has no debt on its balance sheet. In fact, it's significantly net cash positive today, and again, that makes it quite a bit safer than Innovative Industrial Properties if you're thinking of investing in the common equity, because Innovative Industrial Properties already has a 20% LTV, which is low leverage, but NewLake has a 0% LTV, and so that makes it quite a bit safer. Ultimately, I think that even despite the occasional tenant difficulties that we'll face, the REIT should be able to sustain its growth over the long run, and its dividend should be safe and keep on rising. Last year, the company faced actually a few tenant issues, and despite that, it was still able to hike its dividend by 8.3% when compared to 2023, and its cash flow grew by about as much as that. If you want to learn more about NewLake Capital Partners and how it's able to sustain and grow its 12% dividend yield, know that we also have an exclusive interview with the CEO of the company that's available at High Yield Landlord. This one is behind a paywall, but you can access it with our 2-week free trial. There will be the second link in the description of this video. By signing up to this free trial, you will also access the rest of my REIT portfolio, all my transactions in real time, and all our other exclusive interviews, including many other REIT CEO interviews. Again, it's a risk-free free trial. You won't be charged anything in the first 14 days, so take advantage of this offer while it's still available. Thank you very much for your interest. Please click the like button, subscribe to your channel, helps me a lot. Let me know what you think in the comment section. See you at my next one. Bye-bye.